Welcome to Japan. Today, we're diving into a fascinating, frankly almost unprecedented scenario that's unfolding right now in the financial landscape. We're going to explore the extreme polarization currently gripping the Japanese stock market. It's a situation where the rising tide is absolutely not lifting all boats. Instead, we're seeing this massive, historic divide opening up between two very different sectors of the economy. So, if you want to understand exactly where capital is flowing right now, and just as importantly, where it's fleeing from, this explainer is going to lay out exactly what the data is showing us. Okay, let's just get right into it. To really wrap our heads around this polarized market, we need to clearly define the two sides of our split reality. Over on the left side, we've got the high-flying tech innovators. We're talking AI and semiconductor-related giants like Fujikura, Taiyo Yuden, and TDK. Right now, they are absorbing massive, almost gravitational levels of capital. But then on the right side, we have the traditional heavyweights. These are companies in the defense and retail sectors, folks like Kawasaki Heavy Industries and J.Front Retailing. While the tech side is just surging to dizzying heights, these traditional stalwarts are really struggling to maintain their footing. It's a market of extreme winners and struggling left-behinds. So what's actually causing this massive influx of capital into the tech side? Well, it basically comes down to this staggering number, 10.5 trillion yen. That is the massive catalyst behind this recent tech surge. It was recently reported that the government is aiming to formulate a new growth strategy, and they're planning to invest a whopping 10.5 trillion yen specifically into physical AI. I mean, think about that. When policy signals funding of that magnitude, the markets react violently. Investors are just scrambling to position themselves in any related stocks, hoping to catch the wave of this massive government-backed technological push. And when we zoom in to look at the micro-level market behavior, the intensity is just palpable. Take a look at the rapid price swings and those heavy volume bars on TDK's 1-minute chart here. It perfectly captures the intense, frantic intraday trading environment that this kind of capital influx creates. And hey, it's not just TDK. Other major MLCC, that's multi-layer ceramic capacitor, and semiconductor players like Taiyo Yuden are experiencing these dramatic daily swings as well. It is a highly volatile, highly reactive environment where fortunes are literally shifting by the minute as money just pours into this AI narrative. But to truly understand the sheer scale of this AI-driven bull run, we've got to pivot the narrative to the ultimate poster child of this trend. We need to talk about the Fujikura phenomenon. So Fujikura is one of the top 3 wire and cable manufacturers, and they are absolutely riding the data center wave right now. Because think about it. As AI expands, data centers expand, and data centers require unimaginable amounts of optical fibers, cables, and flexible printed circuits, which, as it turns out, happens to be exactly what Fujikura specializes in globally. And this brilliantly illustrates just how much the market values their position. Fujikura has reached a truly breathtaking market capitalization of 8 trillion yen. But even more staggering than that is their growth trajectory. Over the last 2.5 years, Fujikura's stock price hasn't just grown, it has absolutely exploded, multiplying by approximately 30 times from its starting point. 30 times. For a major established manufacturing company, a 30-fold increase in such a short window is simply historic. It really highlights just how aggressively capital is concentrating into the infrastructure that supports AI. Now, a 30 times growth curve is rarely a straight line, right? Back in mid-May, following a mid-session earnings announcement on May 14th, the stock suffered a severe 40% drop. It plunged over 6 consecutive days. Honestly, it looked like the bubble had burst. But then, right at the end of May, the company announced a massive upper revision to their forecasts. And the market's reaction? It was instantaneous. The stock reversed immediately into a stop-high surge, hitting its absolute maximum daily trading limit without even opening for trading at lower levels. It just shows the relentless, almost unforgiving momentum of the AI trend right now. Every single dip is being violently bought up. And this momentum isn't just restricted to institutional money either. It is heavily influencing retail investors through NISA, which is Japan's tax-exempt investment account. Now sure, traditional favorites are still hanging on. NTT maintains its consistent dominance at number 1, and titans like Toyota and Mitsubishi Heavy Industries remain top favorites. But here's the absolute crucial takeaway from this data. The Next Fund's Nikkei Semiconductor ETF has ranked in the top 10 for the very first time. We are seeing a very distinct shift in retail sentiment. High-flying tech stocks and semiconductor funds are steadily beginning to replace traditional dividend-yielding stocks in the portfolios of everyday investors. So the crucial question we have to ask is this. If all this capital is flooding into AI and semiconductors, well, where is it coming from? We have to pivot sharply to the other side of the market divide to understand the full picture here. While tech is quite literally reaching for the sky, we are witnessing heavy bleeding in the traditional sectors that are being left behind. This is what we call the traditional plunge. Just look at how this is playing out for defense-related stocks. Kawasaki Heavy Industries, for example, they peaked around the 3,400 yen range back in April. But as capital rotated out, we saw a stark, sustained fall. By late May, it had dropped all the way down to the 2,800 level, and by late June, it was still languishing right around 2,836. This is a massive heavy industrial giant seeing significant value totally wiped out. It stands in such stark contrast to the massive gains we were just looking at in the tech sector. And it's not just heavy industry feeling the pain. The retail sector is facing its own severe struggles. Let's take a look at J.Front Retailing. They're the department store group behind big names like Daimaru and Matsuzakaya. Despite what you might assume is a seemingly strong tourism sector right now, fundamental headwinds are really punishing this traditional stock. Their first quarter net profit is actually down 12% compared to the previous year. Furthermore, their operating margin has dropped from 14.4% down to 13.3%. And looking ahead, they are officially forecasting a 5.6% profit decline for the full year. It's exactly this kind of fundamental weakness that's driving investors away. We can actually dive even deeper into J.Front's struggle by analyzing their margin trading ratios over this period. Notice how violently institutional sentiment shifted here. On March 19th, the credit ratio was a low 0.3, which means heavy short interest. But by May 29th, it had completely flipped to 1.9, with long balances spiking to over 153,000 shares. But then, by June 19th, that optimism just collapsed again, dropping the ratio back down to 0.7 as the long balance plummeted. This totally erratic, shifting credit balance paints a pretty clear picture of a stock struggling to find a floor and really failing to maintain investor confidence. But, of course, to keep things in perspective, it's rarely all doom and gloom. Even in struggling sectors, companies are making moves. For J.Front Retailing, there is a glimmer of traditional hope on the horizon. They're actually opening a brand new shopping center in June, and management projects this new venture will add an additional 1 billion yen in operating profit. It's a really good reminder that these traditional companies are still massive revenue generators, actively trying to pivot and grow their core businesses, even while the broader market focuses its attention elsewhere. Which brings us to the ultimate question we have to ask as we wrap up this explainer. How long can this extreme polarization last? We are looking at a historic, ever-widening gap between the tech winners, fueled by a 10 trillion yen government strategy, and traditional heavyweights battling margin drops and capital flight. Can the market sustain a reality where a cable manufacturer grows 30 times in value while legacy heavy industries and retail icons just plunge? It's a completely divided market that demands close attention, and it leaves us all to ponder the future stability of this two-sided reality. Thanks for joining me for this explainer, and as always, keep your eyes on the data.